You're in a trade. Your analysis was careful. Your entry was precise. You're confident this setup will work. It's based on solid technical patterns, exactly what you've studied for years. Then, price starts moving against you. Slowly at first, then more decisively. Your stop loss is at $48.20. Price hits $48.35, $48.28, $48.23. Your stop is seconds away from being hit, but something inside you refuses to accept it. You analyzed this trade carefully. You were certain. You can't be wrong about this. The market must be wrong. This is just temporary. It will turn around. You move your stop loss to $47.80. You've just violated your most fundamental trading rule. Not because of fear, not because of greed, because your ego couldn't accept being wrong. 20 minutes later, price hits $47.80. You move your stop again, then again. By the time you finally exit, what should have been a $180 loss has become a $620 loss. You've turned a small, manageable loss into a significant account damage. And this isn't the first time. Your ego is quietly destroying your trading account, one refused loss at a time. Until you understand how ego hijacks your loss management process and why admitting you're wrong feels psychologically impossible in the moment, you'll keep turning small losses into catastrophic ones.
The psychology of ego in trading losses. Here's what's actually happening when ego transforms manageable losses into devastating ones, and why being right feels more important than preserving capital. Ego, in psychological terms, is your sense of self-worth tied to your competence and correctness. When you enter a trade based on analysis, your ego attaches itself to that analysis being correct. You're not just predicting market movement, you're demonstrating your competence as a trader. This creates a dangerous equation in your trading psychology. Correct trade equals competent trader equals worthy person. Wrong trade equals incompetent trader equals diminished self-worth. When a trade moves against you, your brain doesn't just process it as the market went a different direction. Your brain processes it as I was wrong, which means I'm incompetent, which threatens my self-worth. This isn't conscious. It's a rapid, automatic psychological protection mechanism. Psychological mechanism 1. Ego defense through reality denial. When your stop loss is about to be hit, your ego generates powerful defenses against accepting the loss. These defenses don't feel like ego protection. They feel like market analysis, strategic thinking, or pattern recognition. Your ego tells you this isn't really a failed trade, it's just noise. The overall structure is still intact. The market is just shaking out weak hands. Your analysis is still correct, the timing just needs adjustment. These aren't analytical observations, they're ego defense mechanisms disguised as trading strategy. Your ego is literally reframing the loss as not really wrong so you don't have to admit error and experience the psychological pain of diminished self-worth. Psychological mechanism 2, sunk cost ego escalation. Once you've committed analysis, time, and capital to a trade, your ego becomes invested in that commitment being validated. The more you've invested, the more your ego needs the trade to work to justify the investment. When the trade fails, instead of accepting the sunk cost and cutting the loss, your ego escalates commitment. I've already analyzed this thoroughly. I've already risked capital. I can't just abandon it. I need to give it more chance to prove I was right. This is ego trying to avoid the psychological cost of admitting wasted effort and wrong analysis. But this avoidance transforms small losses into large ones because you're prioritizing ego preservation over capital preservation. Psychological mechanism 3, selective attention and confirmation bias. When your ego is threatened by a losing trade, your attention system becomes biased. You selectively focus on any market information that could support your original thesis, ignoring information that confirms the trade has failed. You notice small bullish candles in your failing long trade and think, see, it's turning. You ignore the larger bearish structure. You notice a temporary pause in the decline and think the selling is exhausted. You ignore that the downtrend remains intact. Your ego is literally controlling what you see in the market to maintain the possibility that you're still right. This selective perception prevents you from recognizing when a trade has definitively failed. Psychological mechanism 4. Temporal distancing. Your ego tries to defer the moment of accepting wrongness by creating temporal distance. I'm not wrong right now, I'm just early. Given more time, my analysis will be proven correct. This temporal distancing allows your ego to avoid immediate acknowledgement of error by pushing the evaluation point into the future. But meanwhile, your loss is growing. Your ego is buying time to avoid pain at the expense of your capital.
The 5 ego traps that amplify losses. Different ego structures create different loss amplification patterns in trading psychology. Ego trap 1, the analysis pride trap. This trap activates when you've done extensive analysis on a trade. You've looked at multiple time frames, checked various indicators, identified confluence factors. Your ego becomes invested in all that analytical work being correct. When the trade fails, your ego thinks, I did so much analysis. I was so thorough. How can this be wrong? All that work must mean something. I must give it more time to prove the analysis was good. The more analysis you did, the harder it is for your ego to accept the trade failed. Your ego conflates effort with correctness, but the market doesn't care how much analysis you did. It only cares about supply and demand. Your internal dialogue, I spent 2 hours analyzing this setup. I checked everything. This can't be wrong. It's just taking longer to develop than expected. Ego trap 2, the public declaration trap. This trap activates when you've told others about your trade or shared your analysis. Maybe you posted about it, texted a trading friend, or mentioned it in a chat room. Your ego is now publicly attached to this trade being correct. Accepting the loss isn't just private acknowledgement of error, it's public admission of being wrong in front of others. Your ego finds this unbearable, so it keeps you in the trade, moving stops, rationalizing, trying to avoid public wrongness. Your internal dialogue, I told the group I was taking this trade. I explained my reasoning. If I exit now for a loss, I look incompetent. I need this to work out. Ego trap 3. The expert identity trap. This trap activates for experienced traders whose identity is built on their trading expertise. You've been trading for years. You're supposed to know what you're doing. You're supposed to be good at this. When a trade fails, your ego experiences it as an identity threat. I'm an expert trader. Expert traders don't make basic mistakes. This trade failing means I'm not really an expert, which undermines my entire identity. Your ego keeps you in failing trades because exiting admits incompetence, which threatens your expert identity. You'd rather take a larger loss than acknowledge a mistake that contradicts your self-concept. Your internal dialogue, I've been trading for 5 years. I should know better than to exit here. I'm experienced enough to recognize when a trade needs more time versus when it's actually failed. Ego trap 4, the perfectionist trap. This trap activates when your ego is attached to maintaining a perfect or near-perfect record. You hate losses. Every loss feels like a failure, a blemish on your record, evidence of imperfection. When a trade approaches your stop, your ego desperately wants to avoid adding another loss to your record. Moving the stop offers the possibility of converting a loss into a win, preserving your perfect image. Your internal dialogue, I've only had 2 losses this month. I don't want a third. This trade can still work. I'm not giving up on it yet. I refuse to accept another loss when there's still a chance. Ego trap 5, the revenge against being wrong trap. This trap activates after your stop has been hit, but you immediately re-enter because your ego is furious about being proven wrong. You're not re-entering based on new analysis. You're re-entering because your ego demands vindication. The market was wrong to stop me out. I'll prove my original analysis was correct by getting back in and making money. I refuse to accept that I was wrong about the direction. Your internal dialogue, that stop out was wrong. The trade was good. I'm getting back in to prove it. I'll show the market that my analysis was correct.
Meet Yale, the trader whose ego cost him thousands. Yale had been trading for 7 years when he finally calculated the specific cost of his ego. He was a skilled analyst with genuine market knowledge. When he followed his trading plan, his results were solid. But increasingly, Yale's ego was interfering with his loss management. He decided to conduct a painful audit. He reviewed 12 months of trades, identifying every instance where he moved his stop loss after initially setting it, held beyond his stop because he gave it more room, or re-entered immediately after being stopped out. The data was brutal. Trades where Yale honored original stops. 127 trades. Average loss when stopped, $164. These followed his 2% risk rule precisely. Total lost on these trades, $20,828. Trades where ego prevented honoring stops, 41 trades. Average loss when finally exited, $487. These violated his risk rules, some dramatically. Total lost on these trades, $19,967. Yale had taken 41 ego-driven loss amplification trades, and they cost him almost as much as his 127 properly managed losses. If he had honored his stops on those 41 trades, they would have cost approximately $6,724, 41 trades times 164 average loss. His ego had cost him $13,243 in a single year by preventing him from taking normal losses at his planned stops. More devastating? When Yale analyzed his monthly returns, he found that every significant drawdown corresponded to ego-driven loss amplification. His months with the worst performance weren't months where his strategy failed. They were months where his ego prevented him from accepting losses. Inside Yale's mind, the ego-driven loss amplification. Yale documented his internal dialogue during a typical ego-driven loss amplification to understand the exact psychological sequence. The trade setup. Confidence and conviction. Monday, 1:15 p.m. Yale identified what he considered an excellent setup. Strong technical confluence, clear structure, perfect entry point. He spent 90 minutes analyzing before entering. His internal dialogue. This is a great trade. Everything aligns. Multiple timeframes confirming. High conviction setup. This is exactly what my strategy looks for. I'm confident about this one. Yale entered long at $52.40 with his stop at $51.90, risking $175, exactly 2% of his account. His target was $54.20 for a 3.6 to 1 reward-risk ratio. Yale felt good, competent. This trade validated his analytical ability. Price movement against position. Within 20 minutes, price started declining, $52.20, $52.05, $51.95, approaching his stop at $51.90. Yale's initial response was analytical. Okay, price is moving against me. That's normal. Not every trade works immediately. My stop is placed correctly at the invalidation point. If it hits, the setup has failed and I take my planned loss. But as price hit $51.95, just 5 cents from his stop, something shifted in Yale's psychology. Ego activation. The refusal begins. Yale's ego activated. Wait, this can't be right. I analyzed this so carefully. I spent 90 minutes on this analysis. All the confluences were there. I can't be wrong about this. Let me look again. Yale started reviewing his analysis, but he wasn't reviewing objectively. He was searching for validation that his analysis was still correct. See, the larger structure is still bullish. This is just a pullback within the move. The support level is actually a bit lower. I was too tight with my stop. The real invalidation point is $51.40, not $51.90. I should adjust. The first rationalization. Yale's rational brain tried to intervene. Your stop is at $51.90 for a reason. That's where the setup fails structurally. Moving your stop is changing your analysis after price action, not before. That's ego-driven, not strategic. But ego-driven Yale generated compelling counterarguments. This isn't ego, this is recognizing I was too conservative with my stop placement. Look at the bigger picture. The structure is still intact. I'm not being stubborn, I'm being appropriately flexible. Rigid adherence to stops without considering context is mechanical, not strategic. I'm using judgment. These rationalizations felt completely logical to Yale in the moment. He genuinely believed he was making a smart analytical adjustment, not responding to ego. The first stop movement. Yale moved his stop from $51.90 to $51.40. He just increased his risk from $175 to $350, double his rule. The moment he moved it, Yale felt relief. His ego had successfully avoided the immediate pain of being wrong. He told himself, "Good, now the trade has proper room to work." This was the right adjustment. Price continued declining. Price stabilized briefly at $51.85, and Yale felt validated. See, moving the stop was correct. It would have stopped me out, and now it's bouncing. My adjusted analysis was right. But 10 minutes later, price continued falling. $51.70, $51.55, $51.45, approaching his new stop at $51.40. Ego escalation, the second defense. Yale's ego escalated. This still doesn't make sense. The broader market is strong. The sector is performing. This stock has been resilient. There's no reason for this weakness. This has to be temporary selling. I'm not wrong about the direction. There's just unexpected selling pressure. Yale was now actively arguing with the market. His ego couldn't accept that his analysis was simply incorrect. It had to be that the market was temporarily wrong, not him. The second rationalization. Think about all those times you got shaken out right before the trade worked. Remember that trade last month? You got stopped out and it immediately reversed to your target without you. Don't make that mistake again. This is one of those shakeout situations. Hold through it. Yale's ego was using selective memory, retrieving the 1 or 2 times holding worked while ignoring the dozens of times moving stops amplified losses. The second stop movement. Yale moved his stop to $51. His risk was now $490, nearly triple his rule. But his ego framed it differently. I'm not increasing risk recklessly. I'm recognizing that the setup is still valid and needs more room. This is strategic position management. The final deterioration. Price fell through $51. Yale moved his stop again to $50.60. His risk was now $630. At $50.65, Yale finally exited, not because his stop was hit, but because he finally couldn't maintain the psychological denial anymore. The loss was simply too large to continue rationalizing. The aftermath. Yale lost $630 on a trade that should have lost $175.
His ego had cost him $455, more than 2.5 times his planned risk. Sitting there, Yale felt a mixture of emotions: anger at the market, frustration with himself, but also a subtle ego protection mechanism still at work. The analysis was actually correct. The direction was right eventually, I just got in too early. My analysis skill is fine, my timing was just off. Even after the devastating loss, Yale's ego was still trying to preserve his sense of competence by reframing the complete failure as a partial success. Right direction, wrong timing.
The anatomy of ego-driven loss amplification. Yale analyzed his pattern and identified exactly how ego transformed small losses into large ones. Amplification Pattern 1. Progressive Stop Movement. Yale's ego-driven trades followed a consistent pattern. First stop movement doubled the loss. Second movement tripled it. Third movement quadrupled it. The ego escalated commitment progressively, each movement making the next movement psychologically easier. The first stop movement was the hardest for ego to justify, but once Yale violated his stop rule once, violating it again became easier because he'd already compromised his principle. Ego-driven compromise accelerated with each iteration. Amplification Pattern 2. Analytical Deterioration. As Yale's ego took control, the quality of his analysis deteriorated dramatically. His initial analysis was genuinely good, systematic, multi-time frame, probability-based. His ego-driven analysis was selective, biased, and emotionally motivated. But Yale couldn't recognize this deterioration in the moment because his ego convinced him he was doing deeper analysis or considering broader context. Ego doesn't just prevent accepting losses, it corrupts the analytical process itself. Amplification Pattern 3. Escalating Time Investment. The longer Yale stayed in a failing trade, the more his ego became invested in being right. Time became a sunk cost that ego wanted to justify. I've been in this trade for 2 hours now. I've monitored it closely. I've adjusted carefully. All that time must mean something. I can't just abandon it. This time-based ego escalation made each minute in the trade increase the psychological difficulty of exiting. Yale wasn't just fighting the loss, he was fighting the idea that all his time was wasted. Amplification Pattern 4. Identity Threat Intensification. As losses grew larger, the identity threat intensified paradoxically. A $175 loss Yale could accept as normal trading. A $630 loss felt like evidence of serious incompetence. So the larger the loss grew, the more his ego fought to avoid accepting it. This created a vicious cycle. Ego prevented accepting small loss. Loss grew larger. Larger loss intensified ego threat. Ego fought harder to avoid accepting loss. Loss grew even larger. In ego-driven loss amplification, Yale's perception of market reality progressively distorted. He saw bounce patterns that didn't exist. He interpreted consolidation as preparing to reverse. He found bullish signals in neutral or bearish price action. His ego wasn't just preventing him from accepting reality, it was actively creating an alternative reality where he was still right and the market was about to prove it.
Yale's transformation, building ego-resistant systems. Everything changed when Yale stopped trying to control his ego through self-awareness and started building systems that separated his ego from his loss management process. System 1. Non-negotiable automated stops. Yale's most powerful intervention was removing his ability to move stops. He configured his trading platform to automatically execute stop-loss orders. Once set, he physically could not adjust them through the platform. To change a stop, Yale would have to close the position manually, calculate the new stop, and re-enter, a process requiring multiple steps and several minutes.
This friction made ego-driven stop movement functionally impossible during the emotional heat of a losing trade. This system didn't require Yale to overcome his ego. It simply removed his ability to act on ego-driven impulses. System 2. Pre-trade loss acceptance ritual. Before entering any trade, Yale implemented a mandatory loss acceptance ritual. He wrote in his journal, "My stop on this trade is price. If this stop is hit, I will lose dollar amount. I accept this loss completely right now before entering. This loss is acceptable and expected as part of my edge." By accepting the loss before entering, Yale's ego was no longer surprised or threatened when price approached the stop. He'd already processed the loss psychologically. This pre-acceptance dramatically reduced ego's resistance to actually taking the loss when it occurred. System 3. Ego state awareness checkpoints. Yale set random alerts during trading sessions. When they sounded, he had to pause and complete an ego state assessment. Am I currently attached to being right about an active trade? Am I experiencing the need to be proven correct? Am I defending a position rather than analyzing it objectively? Would I enter this trade at current prices with fresh analysis? This last question was particularly powerful. If Yale wouldn't enter the trade at current prices, then staying in it was ego-driven, not strategy-driven. This realization often provided the clarity needed to exit. System 4. Third-party stop enforcement. Yale recruited a trading accountability partner. When Yale entered a trade, he texted his partner, "Long XYZ at $52.40, stop at $51.90. His partner's job was simple. Text Yale when price hit the stop saying, "Stop hit, exit now." This external voice bypassed Yale's internal ego conflict. His ego could argue with his own rational brain, but receiving an external message saying, "Stop hit," created social accountability that overpowered ego-driven resistance. System 5. Identity reframing. Yale rewrote his trading identity to separate competence from individual trade outcomes. His new self-concept, "I am a competent trader because I follow my process with discipline, not because every trade is correct. Taking losses at my stops is evidence of competence, not incompetence. Ego-driven stop movement is evidence of incompetence." This identity reframe transformed losses from ego threats to ego validations. Taking his planned loss proved his competence as a disciplined trader. Moving his stop proved incompetence as an ego-driven trader. System 6. Loss normalization visualization. Yale created a visual reminder of his expected loss frequency. Based on his strategy, he expected approximately 37% of trades to hit his stop. He created a chart showing that across 100 trades, 37 losses were expected and normal. This visualization made losses feel like part of the statistical pattern rather than individual failures. His ego could accept loss number 12 of an expected 37 rather than "I was wrong again." The breakthrough realization. 11 months into his transformation, Yale was in a trade that quickly moved against him. His stop was seconds from being hit. He felt the familiar ego activation, the need to be right, the desire to move the stop, the belief that the trade just needed more time. But Yale had a profound realization. This feeling I'm having right now, this need to be right, has nothing to do with trading and everything to do with my ego needing validation. The market doesn't care about my ego. The market doesn't care if I'm right or wrong. Only I care. And caring about being right is costing me thousands of dollars. I can either protect my ego or protect my capital. I can't do both. Yale's stop was hit. He took his planned $182 loss, and for the first time in years, he felt proud of the loss. Not because losing felt good, but because taking the loss despite his ego screaming to avoid it was evidence of genuine growth. Yale's results, the transformation in numbers. The changes in Yale's results after implementing ego-resistant systems were dramatic.
Before systems, 41 ego-driven loss amplifications over 12 months. These cost an additional $13,243 beyond planned stops. Monthly drawdowns directly correlated with ego episodes. Largest single loss, $823 on a trade that should have been $175. After systems, 3 ego-driven incidents over 12 months, a 93% reduction. Additional cost from these 3 incidents, $456. Monthly performance became consistent and predictable. Largest single loss, $214, just above planned maximum. Annual return improved from 11% to 29%. Same markets, same base strategy. The only difference was that Yale's systems prevented his ego from transforming small losses into large ones.
How to stop ego from amplifying losses. Your action plan. If you recognize this pattern in your trading, here's your systematic approach. Step 1. Calculate your ego tax. Review your last 100 trades. Identify trades where you moved stops or held beyond your stop because you gave it room. Calculate what these trades cost versus what they would have cost at your original stops. This is your ego tax. Make it visible. Step 2. Implement automated stop execution. Configure your trading platform to automatically execute stop losses. Remove your ability to manually adjust them once set. Make ego-driven stop movement technically impossible. Step 3. Create pre-trade loss acceptance. Before every trade, write, "My stop is price. My loss will be amount. I accept this loss completely right now." Establish psychological acceptance before entering, not during. Step 4. Create the re-entry question. When considering moving a stop, ask, "Would I enter this trade right now at current price with fresh analysis?" If no, then staying is ego-driven. Exit. Step 5. Establish external stop accountability. Share your stops with someone else when you enter trades. Let them tell you when stops are hit. External voices bypass internal ego conflicts. Step 6. Reframe your trading identity. Write new identity statements. I am competent because I follow my process, not because I'm always right. Taking planned losses is evidence of discipline and competence. Step 7. Visualize expected loss frequency. Create a chart showing that if your strategy has a 60% win rate, 40 losses per 100 trades is expected and normal. Make losses feel statistical, not personal. Step 8. Track ego episodes monthly. Document each ego-driven incident monthly. Graph the frequency over time. Your goal is to see this number approaching 0 through systematic intervention.
The fundamental truth about ego and trading losses. Here's what Yale ultimately learned. Your ego will always want to be right. That's its job. Ego exists to protect your sense of competence and self-worth. You cannot eliminate ego from your psychology, but you can prevent ego from controlling your loss management. The solution isn't having less ego. The solution is building systems that don't allow ego to make trading decisions. Your ego transforms small losses into large ones through a simple mechanism. It prioritizes being right over preserving capital. When these two goals conflict, ego chooses validation over money. This is why ego-driven traders can have correct analytical abilities, yet consistently lose money. The market doesn't care about your ego. It doesn't care if you're right or wrong. It only cares about supply and demand. When you let ego drive your loss management, you're fighting a battle the market isn't even participating in. Stop trying to have a smaller ego. Start building systems that separate ego from execution. Automate your stops. Pre-accept your losses. Use external accountability. Reframe losses as proof of discipline rather than evidence of incompetence.
Your ego will always resist accepting you're wrong, but your systems don't have egos. Let your systems manage your losses. That's how ego stops turning small losses into catastrophic ones.